Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with September 2016's Charts on the Move. As this is the start of a new quarter, I'll be presenting a broader view of the markets. I got quite a few charts, so let's get started. My first chart is the third quarter's returns chart. The big winner for the quarter was the emerging markets with a 9% gain. This was followed by U.S. small caps up 8%, Europe up almost 6%, and silver rising 5.4%. Year to date, silver's the big winner, up 40%, followed by gold at 24.5%, and the emerging markets breaking north of the 16% barrier. Clearly, 2016 is turning out to be a reversion to the mean year, as this year's winners were the ones that had been punished the worst over the past 3 to 5 years. In my next chart of U.S. sector returns, you can see technology led the way for the quarter, up almost 7%. Industrials and financials were next best, up just slightly better than 1%. The loser was utilities, though, declining more than 9%, followed by staples with a 6% to the downside. If I change the view to the year-to-date sector returns chart, it's interesting to note how some of the Q3 losers have done quite well for the year. 2016 is following in the 2015 footsteps, as we're seeing a lot of sector rotation. Many market analysts, including myself, have said this market needs to go through a bear market correction as defined by a 20% drop before it can move on to much higher levels. One school of thought, though, is while the overall market has not experienced a bear market since 2009 bottom, most of the individual sectors have. Since 2015, materials have fallen more than 25%, biotech more than 40%, healthcare 20%, transport 30%, home builders 25%, energy 45%, financials 20%, small caps 25%, and the list goes on. With this in mind, maybe that much needed bear market has actually already been behind us, and it's time to accept this market for what it is, full of bull. We don't have to like it, understand it, or be able to explain it. Rather, we should embrace it for what it is and try to enjoy it forever how long it may last. My next chart is that of the U.S. bond market index. Price continues to march higher and stay contained obediently within the blue channel boundaries. Momentum is strong in unwinding its recent overbought condition during the past 2 months, where prices chop sideways. You can see the conundrum that even though price has currently formed a bull flag with a breakout pointing to much higher prices, we are currently up against resistance of the upper boundary, where historically prices reversed course and gone on to retag lower support. This is another example of a technical mixed signal, which has me on alert and watching closely. Moving on to equities, taking a look at the S&P 500 weekly chart, price broke out to new highs and is currently in the process of backtesting the breakout level. Price sits right on the rising blue support line with momentum rising in the bullish zone. Switching to a daily view of the S&P 500, I wanted to look at this time frame as it does a much better job providing more detail than is obvious on the weekly chart. In past videos and in blog posts, I have frequently mentioned a few technical principles without much explanation. With the S&P 500 acting them out to a T, I wanted to take the time here to highlight them as it will not be the last time I mention them or that they'll occur. Breakouts occur when price either breaks above or below a critical line of support and resistance. In this case, the red horizontal line, prior to July's breakout, had acted as strong resistance as price failed each of the last 7 times it attempted to move above it. As we know, in early July, price finally broke above it and within 4 to 5 trading days began to consolidate. This is not unusual and happens because the bulls used all their ammo fighting the bears to get through that level and needed time to rest, regroup, and find more buyers. What usually, but not always happens, the bears temporarily wrestle control back and push price right back down to that same red horizontal line where it broke out. The bulls then step up and take back control. The 3 basic technical takeaways that have just occurred and worth highlighting here are 1. The more times price tests an important level, either from below or above, the more likely it is to break through it. 2. When a level in the past acts as resistance, once broken, it becomes support. The converse is true too. And finally, 3, price confirms the breakout on a back test to the support line and then the resumption of the move higher. On a breakout and subsequent back test and then a failure below the level, this is the definition of a bull trap. Moving on to stocks beyond the U.S. borders, my next chart is that of the emerging markets, which continue to power higher on its way to its inverse head and shoulders pattern target marked by the 42-43 area. Momentum is strong and rising while prices above a rising 200-day moving average. This looks strong. Latin America, in my next chart, as you would expect, looks similar to the emerging markets. Higher highs followed by higher lows. Momentum is in the bullish zone and rising while prices above a rising 200-day moving average. In my next chart of Asia ex-Japan, it's almost a mirror of Latin America and the emerging markets. It too looks very strong with a lot more upside potential. Of course, I would be remiss to mention the fact that price sits right at the upper boundary of the blue channel. So I would expect some near-term weakness here as the bulls rest and regroup. A look at developed Europe in my next chart shows some interesting developments at hand, but not yet worthy of your investment dollars. Price has made a higher low, but has yet to confirm the uptrend with a higher high. While price is above a 200-day moving average, it is now just starting to flatten from its downward trajectory. Momentum is rising, but it has yet to move into the bullish zone. All in all, Europe is improving and starting to look better, but not yet ready for prime time. I'll close this video out with two final charts, a look at gold and the miners. In the next chart of gold, you can see price stalled at a logical resistance point and has since consolidated sideways. Momentum topped and is running sideways, while price is strongly above a rising 200-day moving average. Recent price action has formed what looks to me like a bull flag, which has an upside target near 1550. To help confirm this read, volume during this consolidation has declined, which is exactly what gold bugs want to see. With such a strong move this year, it would not surprise me if this consolidation lasts longer than gold investors would like, but also provide potentially more downside. Unless near-term price action goes beyond support levels, my read is that this is just a normal pullback within a bull market uptrend. My last chart of the miners looks very similar to gold, as price is currently consolidating at a level where one would expect. Notice how price closed the 2013 gap and immediately reversed lower? This, like the technical examples in the S&P 500 above, is a classic example of how price eventually goes on to fill all open gaps, and a reason to pay attention to any open gap on your charts. Also, it illustrates how gaps can act as strong support resistance levels. In this case, it was a strong level of resistance as the bear stepped in immediately once it was hit and quickly reversed price lower, bringing it down some 20% peak to trough. Well, that's it for this month. Stay tuned as I expect some fireworks in the next couple of months. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with September 2016's Charts on the Move.